Is there one strong argument you can give, Pattu, to convince my mind that I'm not missing out on further gains by staying in equity? Like, what is that one thought that is it a is it an emotional thing? Is there any logic? Like, perhaps logic will help here.
It's just 5%. That's how you allocate it. You're still going to be invested in equity. Your future investments are also going to be in equity. The investment that you're going to make next month is still going to be as per the 50-50 asset allocation. You're still going to be in the market. You're just going to pull out a small amount of. So let's say you just pulled out not even one slice of a cake. You're just going to pull out the topping of one slice. That's all.
This is it. This is what completes the picture. These are the final few pieces to the puzzle. This is what we've been slowly building up to. Not that we are saying that Let's Get Rich with Part 2 is ending, but this is the crux of the matter. This is the main topic. The topic of today's episode is what next? I've started my investing journey. I have all the pieces of the puzzle in place, at least depending on the last few episodes of Let's Get Rich with Part 2, insurance, emergency fund. I've started investing. It's trying to be 50-50 for, fixed income and equity. But what next? That is today's topic, right? Is my investing journey where I just let my SIPs keep building for the next 10, 15 years without looking at them? Is my investing journey like that famous Honda ad? Fill it, shut it, forget it, right? Or is there something that has been missing, and something that is missing also on online portals, and nobody's creating this particular content? But to what is this topic of what next all about? Why is it so important? And why is there hardly anything online about this thing that ties everything all together?
Yeah. So I think most of us, money managers, as well as people who are into content creating about personal finance and money, they talk about products, and they talk about which product is good, which product is good for your tax, etc., etc., and so on. But there is very little discussion on the process of managing money. How should I manage my money for a particular goal? I think, yeah, it's at this point it should be fairly common sense, given the kind of content that we have, that you choose an index fund, choose a 40% or 50% of fixed income, and the rest in equity for long time goals, assuming that you are like 30ish or in your 20s. That's about it. And what next? Is that enough? So the answer to that is, people are asking the wrong questions. I've always said this several times before. If you ask the wrong questions, you will never find the right answers. So instead of asking, can I invest here? Is this product good? People should stop and ask, how should I invest? Instead of where should I invest? And where should I invest? A wrong question. Where should I invest? I'm not saying it's the wrong question. It's a wrong question to ask first. That's probably the last question you should be answering. So how should I invest? What is the process? Do I have an investment strategy in place? And that strategy should be something more than keep investing, hope the market will move up in future, and I'll make the money I need. I think it has to be something better than that. Like I keep saying, I think we need to respect our money a little bit more than that, than leaving it to luck and chance. So I think we should talk about how to create a strategy, and that strategy should work regardless of market conditions. So that should be our aim.
I think the crux of this episode, Pattu, sorry, is that, as you said, some people want to get rich, right? They put a lot of effort. Say if they've watched our show, or they've suddenly realized I need to be really passionate about retirement. They put a lot of effort at that point when they start for the first time this entire analysis, and they start on their journey. And then many people get busy. Many people assign it to somebody. Just take care of my finances, please. Just please take care of my family's finances. Most of it is SIPs, because many people are salaried. Most of it, what I'm trying to say is, there's a large amount of effort at the start, and then it's almost on autopilot. So I think perhaps that's the crux of this episode. What next? What happens, say, 1 year later, 2 years later, etc., etc. And once you have your asset allocation, let's start at the base, at the start, right? But to say you're 2 years down the road, Firstly, how do you look at it all together? Is there a way you recommend to, tabulate it? Is it Excel? Is there an app you can use? How do you see your net worth? How do you see your journey and monitor it idly on one screen, one dashboard? Or am I asking for too much? Because personally, if you ask me, I invest mutual funds, some directly through some companies, some through some other ways, etc., etc. I buy my insurance directly, I buy, etc., etc. So how do I see an overview of all this? Is there any way that you recommend?
So I think we should first answer how often should you do it and what should you look at. And I think the problem there is many people look at their portfolios every day. They have
Right.
apps today. They have a lot of stuff which can give you fancy graphs, pie charts, and so on. And I think it's a waste of time, and it just makes you, jittery, because somebody is going to write. Just yesterday, there was a headline that said small caps fell the largest
Yeah.
in the and so on, and you're just gonna get unnerved by it, and you feel you need to do something. You need to control the fall, or you need to change because something else is moving higher than what you have in your portfolio. And I think we should stop that practice of looking often, if maybe not every day, every
Interesting.
week. And there are people I know who send emails from their spreadsheets every day, every week, and so on. I think all that should be avoided. Yes, the goal is we should set our portfolio on autopilot.
Okay.
But the point is, have we done the pre-flight checks first? Then only you can set it on autopilot.
And
Right?
by pre-flight checks, you mean first identify what your goal is, right? And when I say goal, is it, your rough number, say if it's 7 CR, 10 CR, whatever it is, that's the main thing, right? The work. Using the 30 times yearly expenses, whatever it is, the tools you want, you first identify a goal, then you back calculate, and then you try and figure out how much you need to invest, right? Is that what you're saying about pre-flight checks?
Yes, you have a clear goal-based investing strategy. It can be very meticulous or it can be thumb rule based. Whatever it is, write it down somewhere and say, that is my objective. Everything else. So like I said, there are two problems. One is people are looking at things often. And
Right.
the second problem is that they're looking at the wrong things often.
Which would be?
Looking at how much my portfolio gained every day. What are my returns? How much? So which stock in my portfolio is the highest gainer, the maximum loser? Same for mutual funds. Which fund is beating the index? Which fund is not beating the index? So and so on and so on and so on. You're looking at the wrong things. I'm not saying you shouldn't look at it.
It is
But-
human tendency, right? It's
that
very
is-
normal human behavior.
Absolutely.
Yeah.
I would do it too, but that should be one among other things. And I would say that should be the last thing you look at. So that's where the pre-flight checks come in. You have an asset allocation and you start looking at, in stock picking, you have the what you call the bottom top approach and the top down approach.
Can you describe what that is?
So you look at the business, and then you look outward, and then you look at the industry. That's the I think that's the bottom to top approach. I may be wrong. Then there's a top down approach. Then you look at the market, you look at the
And say
players,
which companies are the
and so on. So we should have a top down approach. So you look at first, what is the corpus I need?
right.
What is my asset allocation to achieve it? What is my current asset allocation? And asset allocations will not change much. Initially, it will not change much over a few weeks or a month. So you don't need to look at that once a year. So my recommendation is you create a plan, start investing systematically, look at your portfolio maybe every December as a recommendation, because typically many people have vacations in December. They have some time in their hands. You have a
Or
holidays.
Diwali break.
Whatever
Yeah.
gives you the longest set of, and spend no more than 30 minutes on your portfolio once a year. That's it.
Wow.
You don't need to look at it at all. If you must be confident enough to do that, right? And that is all the time you need. You don't need any more. As long as you know what to look at, you need only 30 minutes.
So what should we look at in that half an hour? This is quite exciting.
Yeah. So first find out, check whether you have invested as per your investment schedule. You're going to tell yourself, I'm going to put 10,000 rupees for retirement for the next 12 every month for the next 12 months.
Right.
Have I done that?
Fair enough. Okay. So that's the first check mark.
Right.
Have you hit your regular investments? And for freelancers, don't feel left out here. It is invest when you can, right? Is that fair, Pattu?
Invest when you can, but keep track and, kind of make up for it. Sometimes things, you get a very good set of, clients, whatever engagements, and you get a little more income than average, then you make up for it.
Sure.
So those are things you meticulously track. So one of my precious assets, I'm not sure if I mentioned, is one Excel file that I've maintained for the last 12, 13 years.
You mentioned it a few times, yeah.
I think so. So so that is my precious asset. I once lost it. I finally got it back. So that's what gives you the confidence that you're doing well. I would say track the money that you're investing.
So what is it that feels good, Pattu, that no matter what, you were consistent in your investing?
Yes. Or it doesn't matter.
Even if you missed a couple of months, it doesn't matter.
There was a period when I could not invest regularly for almost 2 years. But I kept track of it and kind of made up for it later.
Oh, so you keep a track of how much you're lagging behind and then try and make up. Interesting.
Yes, that is the first thing to always keep a check on.
So to counter you there, Pattu, suppose you figure out how much you need to invest every single month and you allocate 100% of that to an SIP. Isn't that doing it for you? And then
sometimes it will work, sometimes it won't. So
tell us why. What is wrong with the SIP part of this entire systematic invest?
I have nothing wrong with the SIP. The problem with an SIP is that sometimes you may need to spend a little more. So you have your SIP for 10,000, 15,000, 20,000, whatever. But sometimes a month or two, your expenses can be a little bit higher. And then it will pinch you if your SIPs withdraw that money and then you're left with nothing.
Interesting.
So I had this trouble early on. I also used to think nothing more than every time I wanted to invest more, I will start an SIP. But then what happened was that it became very difficult for me to manage my expenses. I can't run to my emergency fund every time my expenses fluctuate because of inflation. See, there are months where in a year when vegetable expenses are slightly higher because
Absolutely.
of, you can't go to your emergency fund. If you go to your emergency fund for that, how do you replenish your emergency fund? You're going to replenish your emergency fund from your income, right? So so you must have some flexibility in your take-home pay to handle these kind of vicissitudes, monthly ups and downs in expenses.
This is a very reassuring thought that you may fall short a few months, but that's fine.
Yeah.
And I think that's why I stopped SIPs personally as well, and it feels so good to hear this.
Yeah, no, right? I strongly recommend people to stop SIPs and manually push in as much money as they can afford to every month. Maybe at the end of the month. Because now when they know that these expenses are more or less, how the rest of the month is going to pan out, maybe in the last few days of the month, last week of the month, and you're going to get your salary next month for a salaried again. But that flexibility gives you some peace of mind. Because if you lock money into SIPs, you're in trouble.
Yeah, and the amazing flip side of that problem of SIPs also is that perhaps if you keep it at a low limit so that, perhaps your monthly expenses are not affected, then that's too low. Then you're not investing enough.
Exactly. Right? A lot of people make the mistake. They will many people ask me, can I invest 10% of my take home, 5% of my take home? No, you have to invest a lot more. So therefore, you can't lock away that money in SIPs. You'll have trouble managing your day-to-day expenses. So, and I strongly believe manual investing is disciplined investing. SIP has nothing to do with discipline. SIP is just an automation. We talked about this before. You can't become disciplined just because you set something on autopilot, right? And that has got nothing to do with it. So I think we should manually push in as much as we can and keep meticulous track of it. And it doesn't matter if you start investing in January, on December that year, you say you have done nothing. But you must have a good reason for that. Not because you splurged on this and that, but there must be some unexpected thing where you could not. That's absolutely fine. You're gonna make up for it later.
Okay,
So-
great. So in that first hour we look first half an hour, sorry, we look at if we've been regular in investing, how much we're lagging behind, perhaps. What next is important to look at?
So do we have a plan to make up for it if we have been lagging, and or how much more am I going to invest next year? The thumb rule I have is 10%.
10% should increase every single year.
Ideally, but it's very hard, very, very hard, because it will keep compounding. 10%, imagine your money growing at
crazy,
10%, it will exponentially grow. It is just that I have, it so happens that I'm lucky to achieve financial independence quickly because my investing rate is close to 22%. I've been increasing my investing, the amount I
Year on
put
year.
year on year. Of course, when I
Wow.
look back at it, at 22%. So I've always been higher than that 10%. That is where the wealth part comes in. People ask me naively, okay, so you say you've hit financial independence. Tell me how much you invested and how much is the gain in the market. How much you've gained, the profit, and how much is. When I tell them the numbers, percentage numbers, they say, oh, is that all? I thought money will be 10x, 15x multiply. No, it'll be a very, very timid number, maybe 3x, 4x, 5x, that kind of number. It's a timid number because we have said this before, you need money to make money. So
Yeah. Stay invested, right?
Yeah,
That's
stay
the
invested, but meticulously plan how much more you're going to invest and try to exceed the target. When you exceed the target, you get a little bit of satisfaction, right? A little joy.
I'm sure it's a lot of joy.
Yeah, but that is where I mean, those are things in my control. I cannot control what happens to the market. So there's
Right.
no point. I think it's immature to look at my investments and say, oh yes, my small cap funds have gained 300% in 1 month. That's not going to last.
What has the overall corpus gone? Is that the
Yeah.
main thing?
That's not going to last. So you have to look at what matters, and you have to ensure that the volatility in your portfolio, that is, your portfolio is going to grow. Of course, it's not going to grow nice and smooth like like you see in a Excel sheet. It's going to fluctuate. But can you control the fluctuations? You should not go up and down like that. How do you control it? One is you choose a portfolio which is not heavy on small caps. That is a kid's game, and I think we should not be playing that. We should there's enough money to be made in the large cap segment, maybe a little bit in the mid cap segment for those people who are who have severe FOMO
Or need to be more aggressive because they're
Yeah.
late.
That aggressive thing is I think it's that's wrong.
It's dangerous. I should stop
Uh,
saying it, perhaps. Yeah.
No, I am an aggressive investor. I just mentioned that I've increased my investments every year at 22%.
That's the aggressiveness you need. Yeah.
That is the aggression you can control. You can't be aggressive in the market. Somebody else is, pulling the the cards. You can't do anything about it. So you can't say I'm aggressive. I'll be 100% equity. I'll have 80% of small caps. That's not aggression. What goes up fast will come down just as hard. So that won't work. So I think our goal should be to choose products that will beat inflation, but we should also contain the volatility, because it's not enough if your investments outperform the market when the market is moving up, or goes along with the market. How much does it fall when the market falls? That's where you make the money. That's where the money stays with you. If you look at the people who have fund managers who have bet the market consistently, of course there are only few of them and so on, that's a different matter. They would have always done well during downturns.
Right. By well,
And-
you mean continue to put in money in, or
No, but-
selected the products that have.
The kind of a portfolio which is not too volatile.
Right.
right? It doesn't chase momentum and so on. So that should be our goal. Our goal is to build our wealth, but the fluctuations in our portfolio should not be excessive.
Right.
And today there are apps where you can plot these fluctuations. There are, I have an Excel sheet too and so on, Google Sheet too and so on. But that's not the point. So first thing is we track our investments. Next is we look at our asset allocation. How much has the asset allocation changed from our target asset allocation and the current one? So how much? If it has changed by more than 5%, I would say it's time to do a reset. And that reset is what is known as the rebalancing, right? So let's say you start with 50% equity, 50% fixed income. The next year, because of a bull run, whatever, it is 57% equity.
Right.
Which means you need to sell 7% of your equity corpus and shift it to fixed income.
But that's so hard to do, Pattu. How does one emotionally and mentally overcome? Because I want to stay invested. On one end, you're saying stay invested, but now you're saying pull out from equity and make it safer. So is this the crux of the matter?
That is where the discipline comes in. So it's rebalancing is very counterintuitive, because you are being asked to pull out money from an asset that's performing well to an asset that is not doing well relatively, right? So that is very hard to do. That is possible only when you have your eye on the bigger price, and your bigger price is
quite
not
a mental shift.
Yeah, it is. Your bigger price is achieving your corpus, but achieving it with as low fluctuations as possible. So you have this. So imagine you have this line. This is your path, right? From where you are today to the corpus that you want tomorrow. In Excel, it will be a nice smooth curve with the expected returns and so on. Your corpus is going to grow. It should grow about this line. It should stay close to this line at any point in time. That is the whole aim of portfolio management. If I have a portfolio that fluctuates wildly, then I'm in trouble. Initially, it's okay, but after that, you can't manage it. So I would suggest that you rebalance, but not every year. The typical portfolio manager would say do it every year. But if you do it every year, you have to pay some exit load. Maybe you have to pay some tax depending on the amount you have to. But you don't need to do it. Do it every once in few years when the portfolio increases by 5%. More than 5% of your, or it has fallen down. So if you look at equity, a crash can lower it from 50% to 42%, 43%. Then you will have to shift some.
Isn't that equally tough, taking money out of your fixed income to put into equity? So here's my question to you, Pattu, and if you're comfortable answering this, how many times have you done this rebalancing in your however many years of investing? 15 years, is that right?
Close to that. So yeah. So it depends. So for my child's portfolio, which I maintain separate from my retirement portfolio, for my child's portfolio, I would have rebalanced 3 or 4 times.
In how many years?
Over this 13-year period. But 2 or 3 times among those 4 times, I would have rebalanced twice in a year.
I see.
Because I do a rebalance in March because of the 5% offset. Then after a few months, again, the market is still moving up. I would have, have to do a rebalance again. The benefit is that today today my son is 13 and a half. He's still 5 years away from college, 4.5, 5 years away from college. But for the past 3, 4, 5 years, I have been having enough funds in my fixed income alone to pay for a UG, maybe even a UG plus PG.
Wow.
So, and that is only, what is that? 45, 50%, approximately 50%. So the rest of it is still in equity. So that is the benefit. So I have now, at the peak of the market, you pull out because the market won't stay high forever. It is going to fall. And when it falls, if you do not do the rebalance, you're going to regret.
Right.
So I avoid that regret. And when the going is, it's just like gambling. When you just quit when you're ahead. When it's going, it's. I'm not saying it's gambling, but I'm just saying the logic is the same. When it's something is giving you extra returns, you know it's not going to last. So you better safeguard that, and that is how you tell yourself to pull out money from a well-performing asset class to something that's not so well doing so well.
Is there one strong argument you can give, Pattu, to convince my mind that I'm not missing out on further gains by staying in equity? Like, what is that one thought that is it an emotional thing? Is there any logic? Like, perhaps logic will help here.
It's just 5%. That's how you allocate it. You're still going to be invested in equity. Your future investments are also going to be in equity. The investment that you're going to make next month is still going to be as per the 50-50 asset allocation. You're still going to be in the market. You're just going to pull out a small amount of. So let's say you just pulled out not even one slice of a cake. You're just going to pull out the topping of one slice. That's all. That's all. The rest of it is still in equity. The rest of it is still going to make you money, because it's not equity is not just about getting money when the going is good. You have to have enough resilience when the going is not going to so good. And the problem is, I would think 80% of capital market participants today have no idea what a bear market is at all. They have no idea. They have just been looking at the market since 2013-14, and since then we have had only one bear market from 2018 leading up to the corona crash. That's the bear market period, about 2.5 years. That's the smallest, and after that they've had it's been
great times.
It's been great times. It's not going to last. That kind of excessive partying is not going to last. You can't keep hitting sixes every over. You have to defend, and there are going to be bad patches, and you're going to be ready for it. So that is the point. So again, it's eye on the price. So I can now take more risk for my son's portfolio.
Sure, yeah.
Because I've already got it, and my equity portfolio is not going to go to zero overnight. Yeah, it's going to take a hit. Let it take a hit. My dream is I just keep pushing my little bit rebalance and build my fixed income. The rest of the money I'm just going to add to my retirement corpus after he's done with college.
Right.
So yeah, that's how.
I think that's a good time to call a close to this first part of this entire topic of rebalancing. But before we go, what's the main difference between rebalancing and de-risking?
So I think we should talk about de-risking in detail in the next part. So rebalancing is basically a reset of your portfolio, of your asset allocation.
To go closer back to that 50-50 or whatever your
your target whatever
it was.
Yes. But it's also important to recognize that your target asset allocation cannot always be the same. You start with 50-50 or 60% equity on whatever, but as you head closer to your goal, you will have to slowly decrease your equity allocation, and how we do that and so on, we can talk about it in detail in the next episode.
Thank you so much, Pattu. I'm kind of half convinced that it is very important to do this. I'm just looking for that key thought that will say, hey, Pattu is absolutely right. And I think you're partly there when you say it's only 5%. You have to be a little conserving when we have the eye on the prize. I think these are the key words. Keep your eye on the prize, take out some, skim some of the fat and keep it and protect it. I think you have something coming up.
Yeah, let me add. So just assume that we have the Lok Sabha elections coming next year.
Yes.
What if it's a hung parliament? And what would it do to your stock market? What if there is a coalition kind of government and they pull out after a year? There's a new coalition, they pull out after a year. Why do you think the market was so turbulent in the 90s? One of the reasons was we never had a stable government in the 90s. It was very
Mm.
difficult to form that. So it can happen anytime. A huge crash, a sudden crash like what happened in March 2020, I would say that's not as scary as years and years of uh, moving nowhere, no
As you
momentum.
say, the bigger enemy to our corpus is not a crash, but it's a sideways market for many years.
And that will teach us a very hard lesson of, oh, I should have rebalanced then.
But
That's
Pattu,
the
before we end, then there's another thing that's coming to my mind. How does one time that rebalancing correctly? What if you only do it in December and you missed something important during the year?
um it so I would suggest that initially once a year is enough when you're but after one decade or so of investing, so once you're a little bit down the journey, then you probably need to have a quick look at your asset allocation twice a year.
Right.
Or you look at it when the market's doing extremely well. I mean, you're always going to be hearing news for it somewhere and say, oh, it's a bull market for the last 6 months.
Hmm.
And then that's going to trigger something. You go back, look at your portfolio. If it's more than 5%, rebalance.
Thank you so much, Pattu. I think this is a lot of thinking, and this is something that you just don't find on the internet often enough or enough of. And we'll see you on part two of this episode where we talk about de risking and we perhaps give you case studies of three different people in three different life journeys to represent the large part of the market. One person who is in their mid 20s has just started investing, somebody who's in their mid 30s who's been investing for 10 years, and somebody who's perhaps has only 10 years to retirement, and how these different scenarios and timing and asset allocation and de-risking and rebalancing matters so much on the next episode of Let's Get Rich with Pattu. Pattu, thank you.
Take care. Bye bye.